Hey, good evening, everyone. I'm going live right now, just testing out, make sure the software is working fine. You may have noticed last time when I did a live stream that the software wasn't connecting properly and I wasn't able to stream the way I wanted to. So I just want to go live today just to see that everything is working fine. And for those of you who are watching this, you can go ahead and just comment, and that would be great. That way I can test out everything. This is a great opportunity for you to go ahead and just drop some notes in here, and I'll be able to answer those questions for you. But just testing out the software tonight. I do have things that we could talk about, obviously, but bear with me as I'm just testing out the software again tonight, because I do want to get the live stream going again. Let's see. I can see some things that are live here. If you're on now and you see that things are working well, let's see here. Let's just check one thing out here. So it looks like it looks like everything is working well, and I'm happy that it is, because last time I went live, wasn't able to really use the software the way I wanted to, and so that's great. So if you wanted to shoot some questions my way, I'm happy to do that. I do have some things that I do want to say. There are some really great, significant changes coming very soon with my business and what we're offering for you in terms of financial planning and investments and so on. And I'll drop that information with you in due time. We're just getting everything organized, and it's going to be really some interesting, great news. Actually, we're really excited about what we're going to be doing in the new year, and so stay tuned. You might see some hints as to what we're doing shortly, but you're all going to love it, and it's going to be great news. I wanted to talk a little bit about Canada Pension Plan. I did a video a while ago, and two topics that I had in mind. I don't know if you want to talk about that tonight, but two topics that I had in mind was the Canada Pension Plan. I did that walking video in the forest that you all loved, and I wanted to clear up some of the comments that came through. We're talking about, why would I recommend this or recommend going at a certain age, or why am I not recommending deferring CPP at age 70? And so that whole walking video was sharing with you my insights about my life and what, because I'm a person, I'm an advisor, and I've got my own family, my own life. And so I was sharing with you sort of my thoughts. And it's a rare thing that you're going to hear, I think, advisors who talk about their life. We're busy sharing, ideas about how to improve your life and how to grow and protect your wealth. But very, very seldom do you hear an advisor talking about their own ideas. And so that's what I was really sharing in that walk, was to share with you from my own personal situation and thinking about my longevity and mortality, and that for me, choosing CPP around age 67 seemed appropriate given the mortality rates of people in my family. No one really has made it. I mean, one person that I know of made it past 95, and that was out of all of the relatives, cousins, uncles, aunts that I know of, made it to that big age. Everybody else, mid 80s kind of thing, low mid 80s. And so for me, I'm thinking, well, maybe I'll make it past then. Maybe if I do, I'll feel like I'm greatly blessed. But for that reason, CPP numbers work out better if I take it earlier rather than defer. If you're thinking of taking CPP later, then you'd want to, or if you think you're going to live longer lives, then you would take CPP earlier. Now, that's just one measurement. Of course, there's other measurements go into your plan, like how much money do you have? Do you have a big RSP? Jeff Ray, don't know what you're trying to tell me there, but maybe you could tell me. Hey, it looks like you're tuning in from YouTube, so I'm glad that feed is coming through. We're simultaneously going across Facebook, YouTube, and LinkedIn right now. So good to know that's working. But Jeffrey, if you could just, I don't understand what you're saying there, but be great if you could. Like that one, Mick Trudeau. That's a good one. That's probably from the video that I posted on Friday. And I'll get into that video as well. So that was what that whole CBP, my opinion, was sharing with you my opinion about my life, not about your plan. Your plan, the decision to when to start CBP is driven by your situation, not my situation, not my beliefs, because that's my plan. And my plan is different from yours. And your plan is going to be different from your other friends, neighbors, and colleagues, and so on. So when to take CP is, there's a mathematical answer to when is the optimal time to take CPP, because you'll get the highest payout and the lowest tax issue and so on. But the other part of it is understanding mortality rates and emotional connection to getting money from the government. And so there's striking a balance between those both worlds, right? But I loved your comments, and that was great. The next subject, and I have lots of things that I can share with you in terms of different pieces of information that you might find useful when you're looking at that. So I think I can share with you this one right here. This was understanding CPP at a different ages, right? And so comparing taking CPP at age 60, comparing that to taking CPP at age 65, and then of course the last one, which most of you like to know about, is deferring to age 70. So you can see that if you were to take CPP at age 60, obviously there's no benefit between age 60 to age 70. And so this is understanding how much more you would have had if you had taken it. So by age 60, but if you had taken it at 60, by age 70, you would have had $55,000. And then if you had taken CPP at age 65, you would receive $43,000. So you can see, obviously, you're ahead if you had taken it at age 60. And if you take CPP deferring it to age 70, well, by age 70, you haven't received anything. So by that time, obviously, taking CPP at age 60, you had more money. But if you go to the next line, and that's if you are 75 years of age now, and you took a CPP at 60, you'd have 82,000. But now age 65, so starting CPP at 65, you've just slightly overtaken someone who had taken it at age 60. And then, of course, by age 75, if you deferred and start at age 70, you're not quite there yet. You haven't caught up to either of those two age cohorts. So it looks like age 65 is winning out by the time you get to age 75. Now, this is where the real math comes into play. And this is why I'd said to you before, this is really about your own longevity, the mortality rates in your family. You have to really think clearly about this. And it's not just about living to a big age, it's also living well to a big age so you can enjoy this extra money. So let's go back to that. If you had taken CPP at age 60, by age 80, you have received $110,000. If you started at age 65, that's $129,000. So it's a $19,000 advantage if you waited till age 65. Now, if you take CPP at 70, you will have received $122,000. So it's more than taking at age 60, but not more than waiting to age 65. This is a huge thing for you to consider, because it only really starts to make sense if you're going to live well past age 80. As you can see, taking CPP at age 70, it's $244,000 compared to $215 at 65. So you really have to see that there's some math that works in your favor by deferring, but you got to live well past age 80 and live well, like have a good life, be healthy to enjoy that money. Otherwise, what was the point on deferring your CPP if you're not going to be around in healthy times to be able to enjoy your money? So that was my own feeling on that, given my mortality. Where would I line up in that? And I think somewhere between 65 and 67 seems to be, for me, the right, like, optimal time. and then you mix in what are your assets, how much RSPs, are you doing RSP Meltdown, do you have a pension plan, all of those things, do you have some other sources of income coming in? And so that's the other sort of elements or ingredients into that, making a decision about taking CPP at a certain age. What do you think of those ideas, guys? Let me read your comments, because you got some comments coming in. So dropping the interest rate affect your commuted value for pension. So Jeffrey has a great question about commuted pension. So whether you should commute or not. When interest rates actually are very important to your commuted value, and when you have a low interest rate, you're going to have a higher payout. And so this is important. So if you had commuted your pension 3 or 4 years ago when interest rates were near low zero, then, or more than 3 or 4 years ago, then that would have been useful for you. But when interest rates are really low, it's a good idea to commute. Now, when I say commute, you have to consider a couple of things. What are you going to do with the money? Do you have a need to get into more than just your, is it 5,000 or 8,000 that you're going to have per month? If there is a reason that you need to do that, then that's where you examine, okay, I'm going to have to commute. You're going to lose some money to taxation right away when you commute that value. So that's one of the ingredients, again, into commuting your pension is, do you trust the company that has your pension? So if it's a company that you think that might get swallowed up by a company in the United States, for instance, or a company in Europe, or go bankrupt, then maybe you want to move your pension away and you don't really worry about the interest rates are, because you're worried about the security of your pension. Now, once you get past that decision, then you go into a decision of, well, what is the purpose of commuting your pension? If you're going to say, look, this is the second half of my career or my life, and I want to use that money to launch me into a new business, and we're going to have all this non-registered money to go ahead and do that, then great. Or you're going to have some money in RSPs when you commute your pension, so you could say, look, I want to invest that in real estate, and then you can use a company like Olympia Trust out west to be able to drop that money into real estate projects. So there's got to be a reason why you would just decide to commute your pension. The other thing about commuting pensions that scares the heck out of a lot of people. By the way, thanks for everybody dropping in on this this video, this live stream. I came home this evening. I thought, you know what? I wanted to be able to go live on Sundays, and I thought I had set everything up, and I just want to use this as a test model today to go live. And I didn't really have a lot of things prepared just off the top of my head, and 40 of you have decided to drop in, and so that is really cool. I appreciate you doing that. That's really I'm grateful for you spending some time with me. So the other thing that scares the heck out of people when you commute your pension is the amount of money you're going to get. Most people don't get that kind of money in their lifetime. Maybe when they downsize their home and they rent, or they go into a smaller place. So let's say you're in your late 70s, maybe early 80s, and you downsize your home, and you end up having $1 or $2 million goes into a non-registered, and you fill up your TFSA, and all of a sudden, all your life, you've been putting small amounts of money into RSPs and TFSAs, and it may have grown to a larger amount, but just getting $1 million in your hands or more scares the heck out of people when they don't have relationships with an advisor. And then they got to not only go through that decision matrix of should I commute or not, but now they have to now interview advisors and try to figure out who are they going to trust with dropping that kind of money on them. And if they don't have that kind of relationship, then they also have to think about managing that money themselves. And that scares people quite a bit, because that is their pension, right? That's their retirement plan. And now you put it on your hands. Kind of gives you some insights as to advisors when we manage money. Yeah, I manage money for clients. And, we don't have that connection, that emotional attachment. We're able to manage money outside of that emotional decision. And thankfully, that's probably a blessing, because otherwise we might be as worried as you are. But that it's a great question, Jeffrey, but you really have to think clearly about whether you'd want to commute. And so the one thing you do is you ask your pension manager to give you an estimate as to how much they would have. That sometimes takes a while to get from them. So if you're thinking about doing that in the new year, start asking now, because it might take a little bit of time to get that information. Wow, you guys are just, this is great. Look at all the questions you got here, and that is really awesome. Okay, Chung, thanks for dropping in on YouTube tonight. Best way to withdraw your money. I'm going to put that up here. Chung says, what's the best way to withdraw your money out of a corporation? Okay, well, I don't know you, Chung, but thanks so much for bringing that up, because that's a lot of what I talk about in this channel. Is I talk about how to use whole life insurance. There is a number of different ways to take money out of a corporation. As you know, you can dividend that money out if you like. If you've got some money that is owed to you in a shareholder's loan, then you can just repay that money back to you, and that would come out tax-free. Beyond that, you start having to do some things that are sort of in the gray area of taxation, which I'm not going to go anywhere near tonight talking about that, because that's just not right. But there are certain deductions that you have inside of your corporation that could be useful. But when you're talking about some deductions, we're talking about, you want to take a lot of money out of your corporation, and there's just no way you're going to get those deductions out of, simple things. So the best way to get money out of your corporation, in my opinion, is to use whole life insurance. And if you want, I'll just show you that illustration now. This is really cool, because I have that ready to go. Let's talk about, here we are, right there. This is going to make you guys get a little uncomfortable, because it's the most powerful thing I've ever seen. And I'm going to get this question out of the way, Chung, because it's there. Okay. We're going to compare using whole life insurance to a non-registered portfolio. This is very important. We can't compare this to a TFSA because it's tax sheltered already. We can't compare it to an RRSP because it's tax deferred already. So it doesn't really make sense unless you have a non-registered portfolio. So you ready? I'm going to go through this fast because I don't want to keep you guys on too long. On the left-hand side, that box, this is depositing money into a mutual fund, a segregated fund, an ETF portfolio. Basically, it's a non-registered portfolio. You're going to deposit, as an example, we're going to compare apples to apples, okay? You're going to deposit $1,000 a month for 20 years, $240,000 goes into a non-registered portfolio. In that box, you see it says taxable investment, means you're paying tax on that money. And then you intend to pull that money out. So think about this as being your corporate investment. Okay, Chung, this is, you've got it in ETFs, you've got it in, maybe you've got some GICs in there. All of that is being taxed in your corporation, a 53% tax. This is a passive income tax for the growth of your investments in a corporation. So extremely punishing for you to invest money inside of your corporation. But nonetheless, let's compare that. You put it in your corporation and you're investing that money, you pay tax on it. Then you want to pull that money out later on in life and to supplement your retirement. And the only way to do that is to pull the money out as a dividend coming out of your corporation, and you're going to pay tax on that. So it's not a really useful thing. But let's say you are able to grow that investment up to $489,000 after tax, and you pull that's how much money you're going to pull out of your corporation. So you put in 240, and by the time you're like, call it 71, you decide to pull that money out over a 15-year period, and you're going to be able to take $489,000 into your hands, okay, personally, and then $0 left after. You're going to, in this example, we're showing somebody passing away at age 86. Not you, Chung, just saying in general, okay? So you get to use $489,000 of after-tax money from your non-registered portfolio, and a person passes away at ripe old age of 86, and they have zero money left in that account. So that all makes sense? Now we go to the right-hand side. This is using whole life insurance. This would be held inside of your corporation, and I'm not going to get into mechanics about who owns it in the corporation, whether it should be a separate corporation or in your holding company. Forget about that for now. Let's just look at the same example. $1,000 a month goes into the whole life insurance. where it says permanent life policy. See that? Then that money grows and you don't pay tax on that money. It receives a dividend every year and you don't pay tax on that money. So the advantage right here is that it kind of behaves similarly to a tax-free savings account and maybe an RSP, but meaning that you're not paying tax on the growth right away. So now, same timeline, you're depositing that in for 20 years, you're 71, you decide to take it out for 15 years to supplement your retirement, but instead you take a line of credit. You are going to pledge the cash that's in your whole life insurance policy as collateral, right? Just the same way as you would pledge a rental property and the equity you have in a rental property for a mortgage. Same thing. This is similar to a rental property, except you don't have a tenant. This is just capital, and you say to the bank, I would like to use this capital, this cash in my whole life policy that never is going to go down in value because it's whole life. It's not universal life insurance. Universal life insurance, not a good idea for this kind of strategy. Whole life, the dividend is concrete. It doesn't diminish. It stays. As soon as you get the dividend, that value stays permanently as cash in your policy. Now, you're going to take a line of credit at 90% of the cash value that's in there. That's going to equal to $548,000 coming out in your hands personally. This is the key. You have corporate dollars in a corporate insurance policy, and you're receiving that money personally, never paying it any money in tax at all. All you have is the loan interest, and that loan is going to be paid off when you pass away. The death benefit will cancel the loan, and that money comes to your beneficiaries tax-free. So in this case, at the bottom, 1.3 million goes to your beneficiaries tax-free. On the other side, nothing went to your beneficiaries. So I don't, like, if you can tell me what is better than that strategy, put them in the comments, because I'd love to know, because there are very few things that do what whole life insurance can do for money in your corporation better. There's nothing that I am aware of, because anything else that you put money into, say, for instance, let's say your company buys real estate. Now you've got mixed assets in your corporation, kind of a tricky thing for lifetime capital gains exemption. Not the government doesn't like that. They don't like you to have mixed assets in your corporation. So you got to separate that out. You'll call that purification of your corporations. But you could put it in real estate, but at some point you still have a tax liability that's accruing, and so kind of difficult. But there's very few things that do what whole life can do to pull that money out. Only way to know about that, Chung, is you just ask an insurance advisor. I'm an insurance advisor, but you could just ask them, do an illustration for me. Here's some money, what I've got in my corporation. What could we do with that? But remember, not universal life. Universal life's not good to do it that way, because you can't borrow as much against it. The maximum loan to value you're going to get on that is maybe 60 to 70%. It's not a good product for doing it that way. But great question. Loved it. Okay. Got some more questions here. Okay, so Mick Trudeau, I love it. You guys like that video that I posted the other day on Friday with Trump and Trudeau and Poilievre? It looks like you liked it. It's going through the roof. The views are skyrocketing. Okay, back to what I said before about the CPP. And this question is, I retired at 58, planning on taking CPP at 70. Is a good idea, or should I start at 65 because retiring at 58? So this is simple. It's really the most, and it's what I talked about when I was doing that walking video through the forest. So many of you are trying to thread that needle on CPP. And I really think it's a mistake, because mathematically, life doesn't work out on paper. Mathematically, life works out different ways. You get a lot of bends, lots of curves in your life. So you can take the best possible, if you want to. You get a retirement plan done. This is what obviously I do. You guys pay attention to my channel. You can get scenarios done, says take CPP at 70 and look at that income stream, look at that tax rate, look at your estate values. Then you can take something at 65, 66. So you can get all the scenarios done, where you say, look at all these different dates. You figure out what you think appeals best to you. That's the only way for you to answer that question, is to actually get the math done then you look at that and you say, how much difference is there between taking this decision on this date versus that decision on that date, and weigh that against how long you think you're going to live. And that's how you answer that question. I really don't like these videos where everybody says, take it at 70 or take it at 60 or whatever. I think it's very individualistic, and I would weigh more or put more weighting on how you feel emotionally about when. And I know some people say, why emotionally? But because some people are very adamant about getting money from the government. They've been paying into it for so long. Like, as soon as I turn 60, I'm taking that money. Fine. If you're happy with that, and you know that even though if you deferred, you're going to get less money later on down the line, if you're still content, you're saying, I don't mind, then own it. Make the decision, be happy with it, and get on with your life and enjoy that retirement. That was the purpose of getting to retirement. Now, the other decisions about taking CPP at a certain time are based on whether you need the cash or not. So you are retiring at 58. Obviously, you can't take CPP at 58. You have to wait till age 60. And if you can retire at 58, it tells me that you either have enough RSP or TFSA or a non-registered plan, or you've got a pension plan. Like, there ought to be some money coming in somewhere that you were able to retire at 58. Or maybe, God forbid, but maybe there was some kind of disability and you had to retire, or you couldn't work, or you got let go. So all of those things factor into whether or not you should take CPP, or based on your need. Do you need it? And based on your want. And then you just get a retirement plan. That'll answer your question for you. I hope that answered your question, Mick Trudeau. I have a lot of questions, guys, to go through here. Wow. Great question, Sean. If you have a defined benefit plan, when does it make sense to choose a bridge or not to bridge? I think it's really about your tax rate. Is it going to affect your old age security? Do you have a spouse that you can do pension income splitting? Like, all those things factor into whether or not you should do that or not. Some plans do allow you to have a bridge, and some plans don't. Some plans let you buy into having many different options for that bridge. So it's not always, not every plan is like, you get a bridge and here's your extra money. Some plans you buy into and it helps to enhance other areas of your pension, retiring sooner, for instance, without penalty. So it really depends on your situation about, are you married? Do you have a spouse you can income split with? Is this going to affect your old age security? That's another thing. So longevity of your money, is it going to affect how long is your money going to last, the other assets in your life? So I would say the best way to do that, sounds like I'm trying to promote retirement plans, but honestly, I think it's one of the best things that anybody can do, especially when you're first starting out, is to get a plan done. Like, why wait till 2 years before your retirement to figure out what to do? Start planning well ahead. But I would say get a plan done, choose both options, give me a plan showing a bridge, one not showing a bridge, and that would answer your question really quickly, really easily. Claude, thank you. Thank you for being here, Claude. I'm happy to do this. Actually, guys, I love going live. I like answering your questions. I think there's very few opportunities for you online to be able to talk to an advisor live like this. So if you want me to go live on Sundays, put it in your comments that you want me to go live. Tell me what time. I think the evening is best, and it doesn't interfere with any of the Toronto Maple Leafs schedule, I don't think. So that's okay. It's okay with me anyway. Don't get me talking about the Leafs. I don't want to talk about the Leafs. What about it? So there's always this question about CPP, about people saying, take it early and invest the money. Hey, if you want to do that, do it. Like, I know it sounds like I'm deflecting here, but the truth is CPP is all about you. It's not about the best answer from a textbook, right? It's all about your situation. If you think that you don't need CPP, and you can invest that money and you can do a whole lot better than letting it defer and see what you get later on. So that, I went back to that slide back here as you're recall. Let me go back to that. Not that one. This one. If you look at that and you say, okay, by age, if I defer age 70 and I make it all the way out to age past, like say 90, $244,000. So what you're really saying is, if you take CPP at 60, 61, 62, whatever you want, and you decide to invest that money, are you going to be able to grow that past what they would have given you all those years? That's the answer you're looking for. And the question is, and I always put this onto you guys, and the question is, what is your plan for retirement? Do you plan to have an active retirement where you're not going to be able to be in front of a computer or on your phone where you can do trading and you're worried about what the markets are doing? You can be assured that if you were to invest that money, you would be able to do it well enough that you could beat what Canada Pension Plan would give you over those years. Then have at it. If you are going to be a homebody and you're going to be around your computer and that is what gets you going in the morning and you like trading, get after it and do it if that's what you want. Some people are traveling. Some people go to Florida. Some people go to Arizona and they go and they enjoy golfing and they're out all day long and they're not in front of the computers and trading. So the question would be, would they be active enough to be able to beat what Canada Pension Plan would be able to do for you? So that's all that I would say to you is, if you feel that through your retirement, if you were in a position where either you had an advisor that was going to do it for you, or if you felt that you had the capacity to, when you're in your late 70s and 80s and keep trading. My mother-in-law is 87 and she trades every day. That's her thing. And trying to get her away from the computer during the day is like, it's a mistake. You don't want to bother her during that. That's what gets her juices going. She loves talking about it. And so have at it. If you think that's something that you want to do, then take it early, trade and see how, what you can do. But understand that once you make that decision, you can't go back. It's a permanent reduction of your CPP if you take it anytime before 65. CPP doesn't magically go to the 100% at age 65. You take it at age 60, it's a permanent reduction all the way through your lifetime. Yeah, hey, I was just saying, this one comment said, hey, you guys give me some thumbs up and everything. That would be great too. Oh, this is a great question. James, would you first max out your RSP and TFSA and then do this, or is this first? Okay, James, what does your retirement plan says? What does your financial plan says? Your financial plan is the roadmap to what you should do first, and by how much and the frequency and so on. You should be getting a plan done. So just gets you some insights about like a retirement plan or a financial plan. A financial plan isn't one just document that says, here, this is what you do. A financial plan or retirement plan is the same thing. I think mostly when people talk about financial plans, you might be a little bit younger and you're thinking about the accumulation stage. So you're how much money do I need to put away every month, every year into what? And our goal is this, and then get there. Retirement plan, a lot of people come later on in their life, like in their late 50s, and they say, give us a retirement plan that shows a withdrawal strategy and so on, and tax minimization and estate planning. So they're interchangeable. They're doing the same thing, just the timelines are a little bit different. You should be getting a plan done and have scenarios done that says, if I max out my CPP, if I max out my RSP contributions and then whatever I have left over into the TFSA, what does that look like 30 years from now, depending on, I don't know, James, how old you are, but what does that look like when I'm thinking to have this money come into my hands to support your lifestyle? And then do it the other way. Max out your TFSA, then overflow into your RSP, and then look at how much tax the differences between those two plans, because one's going to have a bigger tax rate than the other. And then look at what the income stream looks like later on in life and the taxation of those income streams, because they're going to be very different, right? And what does your estate value look like? Having a plan and those two scenarios will show you exactly which one works out better for you. And that's the best way to go about answering this question. So I think it was the only way for you to. Now, if I was to say one thing though, because the question kind of suggests that you have more money than the maximum contribution. If you didn't have, and let's say your contribution was 5,000 a year, that's all you had available, then I would go the route of a TFSA. Because if all you have is 5,000, assuming that you're in a low income tax bracket, there's very little benefit to you putting money in an RSP. I would go the route of a TFSA. Okay, let's see what other questions we have. Great questions, guys. Keep them coming. I love it. This is great. Makes sense. Well, okay, Ken, looks like somebody answered that question for you. So thanks a lot to Community Income Investing. Well done. Chung, about your investing situation, it sounds like obviously that you are in a corporation and you're saying, should I take less money in a corporation to offset some unrealized gains? Is one possible way. Could you borrow against your investments? That would be another thing. Pledge them as collateral and borrow against it if you want to get into real estate. The idea about how you take money out of a corporation, let me get rid of this one here because that's not what we're talking about anymore. I have to get that there. The question about how you take money in a corporation is more important, Chung, is whether or not you want to pay into the Canada Pension Plan. As you know, being an incorporated business owner, you're both making your contributions as the employee, and your company, your corporation, is making the contribution. So you have to do both contributions. So it's quite a costly thing for you as a business owner. If you're paying yourself a lower salary, then that's less money going into CPP. And if you're only taking dividends and you're not putting money into CPP, this is something that you have to consider about what does that look like for you at the end of your working years, whether or not you have a succession strategy or you're going to sell that business, close it down, how you're going to use your money. It's very, very complicated for business owners. It's not just a straight line. It requires some careful tax planning on your part. I'm not in favor of just simply paying yourself less salary to avoid capital gain situation. You do have, in a month's time, you have some time to start looking at tax loss harvesting. So that would be one area I'd start looking at right away. Let's see. Good questions. How do you pick, Helen? Wow, what a great question. How do you pick a good, could I substitute good for great? Good is somebody you want to, they cut the grass fairly good, right? How do you pick a great financial advisor? That's a great question, because I have a list actually that I give to people that call me up and they say, hey, we're trying to figure out who to choose. And so you have to first start by saying, who are you? What is special about what you're trying to do? How much money do you have? What's your age? So you look at, I have X amount of money to invest, because some advisors do really well with a certain amount of money, and some advisors do really well at a higher level because they have access to different kinds of investments. So the question is, where are you in that scenario? Your age. And by the way, some advisors do not do really well when you hand them a lot of money. It scares the heck out of them, believe it or not. Some advisors aren't used to that. Some advisors are used to sort of like family market, where they're coming in with a little bit of money to invest in RSPs. They got high debt rates. Their kids are in daycare, so they got a lot of expenses. So there's not a lot of money they can put towards their investments. So they're used to certain dollar amounts every year and certain sizes of accounts. And the moment somebody says, hey, I got 800,000, I got 1.5 million, it scares the heck out of advisor. And they go, well, what if this client, what if I lose this money? Some advisors are like that. So you need to actually talk to an advisor and ask them very specific questions. So the first part of your question deals with you. What's your age? So what's your timeline? Are you a young person who has a long timeline in front of them? And so you want the lowest cost of investing. Maybe it's ETF portfolio, right? And not every advisor is going to have an ETF. If you go to a bank or a brokerage firm, they might have access to that. But the idea of just going into an ETF portfolio at a brokerage firm or a bank, problem is the advisors or the bank's got to make some money off of you, right? So if you're going to a relationship with an advisor and you want an ETF portfolio, I'm almost about to tell you, maybe I should tell you, I'll sneak that in, but we're now offering ETF portfolios. So that's the part of the new news. If you go to an advisor and they're offering you ETFs, and as you know, ETFs are a lower cost option for you to invest, the advisor still needs to make money. And it's going to be difficult to get an advisor to give you advice and not pay them for the advice. So you might have to give up some of that money. So in the sense of paying a fee for the advice, maybe it's 1%, maybe it's 1.2%, depends how much money, could be 0.85%, depends how much money you have. So that's the first thing. Second is your age. If you are a little bit older, so middle of your life, 50-ish kind of thing, then you might be saying, okay, what kind of advisor is this? Does this advisor work with people my age group? Are they more in the family market, the young professionals? Are they only working with people that are 65 and above? Do they only work with dentists or lawyers? Do they only work with widowers? There's a lot of advisors that have niched their practices down that only work with kind of very specific groups of people. I'm among that kind of crowd where I'm working with usually people that are 50 and above. And so, and there's a few other checkpoints, but that's as far as I'll go with that for tonight. So you want to know, who are you? So your timeline, how much money do you have? What's your risk tolerance? So if you got brokers who like to trade stocks, very active, right? You might feel pressured to be doing a lot of trades where you don't want that. That might be a little bit too much activity in your portfolio. And you might like to be sort of in a low to medium kind of risk tolerance. So you don't need to do a lot of trading. So you're got to be sorted out who you are first. As soon as you get that right, which shouldn't take you much time to do that, then you go into the next section, Helen, and that is interview this advisor. How much money do you manage? What's the average client size? What is your median age of clients? Do you work with this environment? Like, how many clients are in my age group? How many clients are at 65? Tell me about your typical day. What does that look like? How long are you going to be working for? Do you have any extra help? Now, you notice right away I didn't go into designations, because I think designations tell you a couple things about the advisor, but it doesn't tell you the whole story about advisors. I can give you right now, because I used to be a director at London Life. So my job was to hire, coach, and develop advisors. And so I could give you lists of advisors that you would be thrilled to have, because they're just awesome advisors. And none of them are CFPs. They just have years and years and years of experience and lots of clients to demonstrate that they know what they're doing. And I can show you CFPs that know what they're doing, and PFPs. And then there are some CFPs that don't know what they're doing, and some PFPs that don't know what they're doing. I want you to think of it like this. Have you ever gone to a doctor and felt like that wasn't the best doctor you've ever been with? But they're all doctors. Or you go to a dentist, and many people have gone through a lot of dentists because it's it's difficult. They're in your mouth, and you want them to be gentle and so on. Some dentists are rough. Some dentists make mistakes and break your teeth where you shouldn't be doing things, or they convince you to do things that you shouldn't be doing. Some dentists are better than others. Some car mechanics are better than others. Some lawyers are better than others. And they all have these degrees and they all have designations. It doesn't mean that they're all great. So you have to make sure that despite their designations, that you ask them, like interview them. That's the way I would manage that. And I have, if you want me to, just email me and I'll give you the list of questions and you can just walk in with this. And if you did that, you might make them uncomfortable. Another thing to do too is when you're with an advisor and they recommend something to you, tell them how much money you're going to make. So throw it on the table. So that's something that advisors are supposed to tell you. They're supposed to give you that information up front. You're not supposed to have to ask them. Those are the new rules behind that. But you do want to know, out of all the recommendations they've made, how much money do they make off of each one of those recommendations? And you want to see which one are they pushing forward right away, this one versus that one. So it's really interesting. It's I don't want to use the word, but it's an important question to ask an advisor. So you see why are they pushing something to where they make a lot of money off of it versus 3 or 4 other decisions they could make. So if you want, just email me, aaronwealthmanagement@gmail.com, and I'm happy to send you the list of questions that you can ask your advisor. But great question. James, I posted the question when you were talking about the corp investment strategy, wondering if that is a priority. I don't know, is it a priority of the question or I'm not sure what your question is, James. Well, thanks, Mick Trudeau, about the saying that I'm a teacher. Yeah, I educate you guys a lot. I put all my videos up. I talk about how to do things. It's not a lot of selling. Hardly ever I sell. It's usually about, this is what this strategy means and how you should use it, who should not use it. That's typically what I do. I'm not for everybody, by the way, if you should know, the way that I invest money. I don't do individual securities. I only use ETFs and segregated funds. Typically work with 50 and above, although I do have clients that are younger than that, especially in the ETF area, because they want low cost investing. But I'm big on education. All my clients, big on education. Okay, I think I've gone through much of the questions right now. Let me just check on one thing here. So I'm going to show you 2 more things, then we're done. How's that? Okay. One relates to retirement planning, and the other relates to how to manage your money a little bit better. Okay, so let's go to the retirement planning one. People ask me about, I've got so much money in an RSP or something to that effect, and I'll say, well, look, here's an example that if you got to 65 and you had, let's say, this 891, it's just an example of an RRSP balance, and you chose to take a minimum withdrawal in your RIF, that by age 90, you would leave $400,000 behind. Okay, that's what this illustration is showing you. It's showing you that when you're in retirement and you take a RIF minimum, that RIF minimum, maybe you don't need the money. Maybe you have other source of income, rental income, or you've got pension income. But essentially, the money that you're using, you think you don't need it, so you just take a RIF minimum because why take money I don't need and pay extra money on it? Well, the reason is because if you do that, you're going to leave $400,000 behind. Now, that number might be bigger depending on how you invest your money. This, I think, was a very conservative. I think it was about 4.5%, 5% rate of return. So this is why we talk about doing RRSP meltdowns in a retirement plan, is to make sure that you don't leave that money behind for Canada Revenue to tax you at your passing. Because in an RRSP, or even in a RIF, when you pass away and you have a spouse, that money rolls over to your spouse on a tax-free basis. You use that money, and then when you pass away, whatever's left over gets sold for cash and included as income in the year that you pass. So that $400,000, as an example, would have been sold for cash. And anybody want to guess, put it in your comments below, if you had $400,000 as income that year, how much your tax rate would be? What would you think your marginal tax rate would be? Somebody type it in. You got to be able to answer this. This should be an easy question for all of you. You would find, oh, too slow, guys, too slow. You would find that your tax rate, your marginal tax rate is going to be 53%. 50 plus, Chung, that's right. So question is, what is better for you? To do a minimum withdrawal, leave it behind for CRA, and write a big check to CRA? Or do you use a withdrawal strategy? So this is an RRSP meltdown or a RRIF meltdown, so that you can target where you have lower tax rates throughout your lifetime and take money out, some more than others, some less, some years more. And we're trying to balance this tax rate. What we're trying to do is flatten your tax rate out, so it's not going up and down too much. We want the tax rate to be within, say, 1% year over year. And what you'll find is you're going to pay less tax doing that compared to just leaving it there to have CRA tax it. That's one thing. The second is just principle. Do you like the idea of your estate writing a check for $200,000 to CRA at your passing? A lot of people say, no, I do not want to see that. So that's where you would start to do that meltdown. So that's what a retirement plan does, is it goes through a meltdown, being aware or being mindful of your tax rate year over year, so that you're not paying so much tax as you melt down that RRSP. So that's the one thing I wanted to share. Simple explanation of RRSP meltdown. A RRIF meltdown is you're in a RRIF and you're doing the same thing. You're doing withdrawals. Okay. And the other, this is about investing. And this is something, because people are asking me, well, what do you do when you take the money out? Okay, so let's go into this. This is a 3-bucket strategy. So I want you to think of the first bucket on the bottom left-hand corner as this is your monthly expenses. You're spending money on utilities and groceries and clothes and going out and putting gas in the car, these kinds of things, right? Paying taxes every year. That's your bucket on the left. That is the amount of money you're going to keep. You see it says 1 year, 2 year, 3 years. You're going to keep that in cash. And maybe you have a laddered GIC strategy where you're saying, okay, I'm going to put for the first quarter of the year, it's going to be in cash, and I'm going to have GICs maturing every quarter after that to replace the cash that I have in my checking account. And that's what I'm going to use to live off of every year. And whether you have 1 year, 2 year, or 3 years is really about your own risk in terms of how much money you think you need. So the 1 year, 2 year, 3 year is really about you thinking, I want to insulate my lifestyle spending in case of some kind of downturn. Because if there is some kind of downturn, then I can insulate all of that downturn and not be pulling money out during a negative environment. Because I'll skip to this and I'll come back to this. If you're pulling money out, it's called sequence of returns. You see this here, bottom right-hand corner. All three of these returns all got 4.8% annualized rate of returns. That center blue line is somebody who's deposited money in over a 10-year period, had a 4.8%, and they had $537,000 after 10 years. But look at the green line at the bottom. The first 2 years of retirement, they had negative returns, and they have the least amount of money, the $472,000. And somebody who had 2 years of positive returns in their first 2 years had $586,000. That's just sequence of returns. And so this is really related to back to this one here, is understanding, trying to control that bucket on the left. That's that part where if you had negative returns and you were pulling money out of your portfolio that wasn't in cash, let's say it's in stocks or some kind of funds, and they go negative and you're pulling money, withdrawing money, you're going to accelerate your balance faster to zero than you would have if you had put your spending in money market or GICs, right? So put your year or 2 years or 3 years of spending in cash and a laddered GIC or money market approach. And then you've got that middle bucket. That's going to be from 3 years to maybe 5 years or 7 or 8, depending on how old you are. And you're going to have more money in there that's related to equities, fixed income, and maybe some REITs or something that is in real estate. You want to have that growing at a rate of return that's not so volatile, middle of the road returns here. So middle of the road in terms of risk profile, that after 1, 2, or 3 years, depending on how much, what you've decided to put in cash, will replenish that middle bucket. It will have grown to the amount that you are putting in cash on the first bucket. So it's this waterfall effect. The third bucket in the top right-hand quadrant is really longer, more riskier investments, more equities, something that's going to be hitting higher rates of return with the possibility of being not so good. So there are going to be some years where maybe they're negative, but the long-term strategy here is that you don't need that money. Divide up your portfolio into sort of years and say, we're going to need this money 15 years from now. Let's try to grow that pool of money differently than the pool of money we're going to need in 5 years to 8 years, and differently from the kind of money we're going to need in 1 to 3 years. Does that make sense? A lot of people don't invest their money this way. A lot of people put their money in funds, and then they're not really thinking about how they're going to be using that money and withdrawing that money in their lifetime. So what you want to do is divide up your money in terms of time horizons and say, this chunk of money is for now, 1 to 3 years. This chunk of money is going to be 5 to 7 to 8 years, depending on how old you are. And this basket of money is for something we're going to need 10 to 15 years from now, depending on how old you are. So you can invest differently in each one of those baskets. Does that make sense? I hope it makes sense. Any more questions? And I think I'm going to call it a night. Thank you, 𝗪𝗆. Thanks for all the love. Thanks for the compliments. I think that's it, guys. I just wanted to say thanks so much for all of your support, for following the channel, for your questions. Continue to make comments and put video requests, because I like to actually do videos that you want me to talk about. The way I am in real life is the way I am right here. I think it's important that we just talk and have normal conversations and answer the questions that you're looking to have answers to. And again, I'm just total gratitude for everything you guys are doing to support the channel. And I look forward to giving you many, many years of videos and advice. And stay tuned for the great news, because I'll be doing videos on the ETFs. There's like 90 ETFs that we have available. Actually, they're available right now, but I don't want to share all the information because we're developing a new website around it. So it's going to be some really great news. That's it. Thanks for tuning in today's video. It was fantastic to see you all on here and all your questions. Much love. Greatly appreciated. I look forward to seeing you in the other videos. Thanks, and be well.